Today, I want to talk you through a real trade that I managed in December of 2024, a situation that every trader of bull put spreads faces at some point. I had a $595, $593 bull put spread on SPY, and the day before expiration, SPY was trading at $588, putting my short put deep in the money. I didn't want to take a loss or risk assignment, so I had to decide how to roll the trade. But the big question was, how far down should I roll it, and how much capital was I willing to commit to keep this trade alive? I analyzed several different expiration dates and strike prices, weighing the trade-offs between avoiding assignment, maintaining a strong net credit, managing the time in the trade, and keeping the capital at risk under control. In this video, I'll break down exactly how I evaluated my choices, what factors I considered when rolling, and why I ultimately picked the trade that best fit my strategy. I always keep cash in reserve in case I need to repair or roll out one of these positions and expand it to get a new net credit. So I'm going to try to roll my short put out of the money. I'm going to look for a new spread that will bring in more than I have to pay to close this one. And I still have $771 available, so if I need to expand this trade, I can do it. So let's look at the option chain. All right, I'm going to look at these two dates, December 27th and December 31st. And I'm going to go out a whole week to December 27th and try to roll it down close to the money or even out of the money if I can. So a $588 or $589 put I could sell for $638. And let's see if I can find one to buy for $400 or just a little more than $400. I could buy one with a strike of $582, but that would, well, actually that would bring me $700 spread. Rather than $200, so I would use up an extra $500 of my available cash, but I would be rolling it close to out of the money and giving it another week to recover. Let's look at December 31st, because I really would like to get this strike price down. Let's look at 585, and if I set it at 585, expiring 12 days out, I could bring in about 600. So 585 to 576, that's a pretty big spread, maybe 577. See if I can roll this for a net credit and lower my strike price. Okay, that's a $300 spread, a $400 spread, still probably not a net credit. A $500 spread, looks like I could get a net credit. Let's see if I can get, I'm going to aim for 14. Unlikely, but if it doesn't fill, I'll try something else. Look at that. It filled. It filled at 15, so I got 1301, and I now have a $500 spread. All right, that's a very respectable 118.72% annualized return, and 588.49 is the current share price. So I haven't quite rolled it all the way out of the money, but almost out of the money. I increased the risk a little bit by putting $500 at risk instead of $200, but I decreased the risk by lowering the strike of the short put. So I think that's a pretty good balance with a decent annualized return, and I am so far okay with this repair. And we'll see what happens over the next week. I'm hoping the share price will recover above 490. Oops, sorry, not 490, 590. Put those numbers in wrong. You change my hundreds place digit. Doesn't change the spread. If you're wondering how this trade turned out, well, it didn't end with just one roll. SPY kept dropping, hitting as low as $578 a share at one point over the next few weeks. So I had to roll the position a few more times to keep avoiding assignment. But here's the good news. I was able to keep rolling for a net credit, adjusting my strikes and expiration dates strategically. And by February, SPY had finally recovered above $600, which meant I could close the position profitably. This trade was a great example of how staying flexible, managing risk, and understanding your choices when rolling a spread can keep you in control, even when the stock moves against you.